Hey guys, this is Alex Owari from ONG Tax and Accounting Services. So in this video, we're going to take a look at reportable transactions of foreign-owned U.S. single-member LLCs. And the focus is going to be on Form 5472 Part V. We're also going to take a look at the Code of Federal Regulation Title 26, 1.6038A-2, which is the regulation, the Treasury regulations that requires foreign-owned U.S. single-member LLCs to be filing pro forma 1120 and 5472 whenever they have a reportable transactions. So the Treasury regulation cited here actually provide two unique examples, and we'll take a look at those examples. And those examples provide, specific fact and analysis from year 1 to year 4. For the purpose of this video, we're going to take a look at only year 1. We're going to combine both examples together and then focus on only year 1. Okay, so we're going to give you fact and analysis and some conclusions on how you need to report certain transactions in 5472 Part V. Now, before we start off, let me throw a word of caution out there, or a disclaimer, that this video is for educational purposes only and it's not meant to be a legal or tax advice. And if at any point in time you need a legal or tax advice, you should always consult a competent tax attorney or a CPA who is going to be able to figure some of this out and help you out with your situation. Now, before we dive deep into the flowchart and give you the examples in the Treasury regulations, let's go ahead and go through the 5472 instructions and basically figure out who must file this 5472. The instructions provide that generally a reporting corporation must file Form 5472 if it had reportable transactions. So this is very key. So the two things you need to be aware of here is reporting corporation and reportable transactions. So we're going to take a look at what is a reporting corporation. So we go here and then we look at the definitions that the IRS has provided on what is a reporting corporation. It says that a 25% foreign-owned U.S. corporation is a reporting corporation. So if you are a foreign person that has formed a U.S. corporation, you own 25% or more, then your entity is a reporting corporation and needs to file 5472 if it has a reportable transaction. The second group of entities that file these forms is a foreign-owned U.S. disregarded entity. So if you're a foreign-owned U.S. disregarded entity, which is a U.S. single-member LLC, for the specific purpose of filing Form 5472, your single-member LLC, which we always say is disregarded, it's seen as a reporting corporation only for the limited purpose of filing Form 5472 and the pro forma 1120. Now, the third entity that falls into this category as a reporting corporation is a foreign corporation that is engaged in U.S. trade or business, and where that foreign corporation has a reportable transaction. So first of all, you need to figure out whether you are a reporting corporation, and then second step of the process is to figure out whether you have a reportable transaction. Because if you do not have a reportable transaction, then you do not have to file this form. Alright, so now that we know what a reporting corporation is, let's go into this and figure out whether a foreign-owned U.S. single-member LLC can claim any exemption from filing these forms. Because as you guys are all aware, the failure to file these forms, or filing it incorrectly, or not filing at all, comes with a $25,000 penalty. So most people would kind of want to be in a situation where they have an exemption so they don't have to file the forms. So in this case, we're going to look at this first point here, number 1. So that for the purpose of this video, we're only going to look at this is section 1 here. If you read it, it says that a reporting corporation is not required to file Form 5472 if any of the following apply. So we look at the first one here, which is generally will apply to a foreign-owned U.S. disregarded entity. The other exceptions you see here does not apply to US disregarded entities, so we don't even have to waste time on it. So let's read the first option here. It says that you're not required to file these forms if you are a reporting corporation and you have no reportable transaction of the type listed in Part IV and VI. Part IV and VI is over here, and I'm going to show you real quick. This Part IV, if you are a fully fledged corporation, okay, so a corporation that is formed in the US or an LLC that has elected to be a corporation, and in that case where you don't have any transactions of any sort in Part IV and Part VI, then the regulations says, or the instruction says, that you should not be filing these forms. So this is only for corporations. We go in here and it says that in the case of a reporting corporation that is a foreign-owned US disregarded entity, it is not required to file 5472 if it has no reportable transaction of the type listed in Part V. So Part V is here. This is Part V. This is the reportable transactions that every foreign owner of a US single member LLC should be concerned about. So when you read it, it tells you to attach a separate sheet and describe any of the transactions listed here. So for example, the IRS want to know amount paid or received in connection with formation, dissolution, acquisition, and disposition of the single member LLC. It also includes contributions that you made to the LLC and then distribution that you made out of the LLC. So as you can see from this exception 1, the first sentences you see here that stops here applies to US corporations. The second here, the continuation here applies to foreign-owned US single-member LLCs. So in the case where you're a foreign-owned US single-member LLC, you're not required to file Form 5472 if you don't have any transactions, any of these transactions listed in Part V. So it's very important that you take note of that. Okay, so now that we've looked at the exemption, one would ask us what counts as reportable transaction for US single member LLCs. And in this case, when you go to this Treasury regulation here, the IRS does a good job. It did really a good job providing two unique examples that point you or gives you guidance as to what kind of transactions the IRS wants to see. So these are the example. There's the example 1 here, and then there's the example 2. So for the purpose of this video, we're going to take these two examples, we're going to merge them together. And because they are so dense, we're going to take a look at only year 1 example. In the subsequent videos, we'll take a look at the year 2, so the transactions that took place in year 2 and how it needs to be reported, year 3 and how that needs to be reported, and then year 4. But in all cases, we'll combine these examples together just to make sure that it makes sense to you. And then we also explain it in a very understandable terms so that if you do not even have any background in tax, you can actually understand what we are driving at. Okay, so we have year 1 examples here, and this is a combination of example 1 and 2. So I'm going to go ahead and read the facts for you, and then we go through the analysis. So the first fact that we have here, it says that in year 1, W forms and contribute assets to X. So here's W. W is a foreign corporation. W can also be a foreign individual. It could be a foreign trust. It could be a foreign partnership. So whatever it is, as long as it is a foreign entity or a foreign person that owns a US single member LLC, we can use it. We can use it as an example. So here it says that W in year 1 forms and contribute asset to X. So let's see how the flowchart looks like. So you have W in year 1 forming and contributing assets to X, which is a domestic limited liability company. So this is a single member LLC. So you have W here, which is a parent, and it formed X. And when it formed X, it contributed this car and this phone to this LLC. So let's move on. The same year, year 1, W forms and contribute assets to Y. So we have the same W here, which is a foreign parent. it continues to form an LLC. So for this example, let's just say that LLC X was formed in Delaware, and then LLC Y is formed in Wyoming. Let's just use this example so that it makes sense to you. So here, in the same year, you have W forming LLC Y and then also contributing a house to that LLC. So that looks all good. Now let's see what's happening again. In the same year, you have X and Y forming and contributing assets to Z. So Z here is also a single member LLC, and I'm going to show you why. Now you have X, which is a US LLC, and then you have Y, which is also a US single member LLC. They are all owned by W. They each contributed the asset they received from their parent to Z, which is also an LLC. This all looks good. So you have X and Y contributing all of the assets they got from their parent to another entity which they have formed. So this looks good. Now let's look at the analysis here. And here's how the IRS analyzes this situation. So here it says that X, Y, and Z are disregarded entities separate from W. So this entity here, X, Y, and Z, they are all disregarded entities because they are all single member LLCs. One would say that, okay, we get it. I understand that YX is a single member LLC. I understand why Y is a single member LLC, but why is Z a single member LLC when it is clear that you have two entities coming together to form Z, which is a US LLC? Shouldn't it be a multiple member LLC or a partnership? Here's where it's important. This here, the IRS analysis wants to tell you that because these entities are disregarded, because this one is also disregarded and they're all owned by one foreign person, this Z here cannot be a multiple member LLC. So we're going to disregard all these entities and then also claim that Z is a US single member LLC. It is not a partnership. That's something that I saw that I think that it's important to note it down, because many people will be confused that you have LLC X and Y coming together will form a partnership, but that's not true because they are all disregarded and they are owned by one person. So Z here would also be disregarded. Alright, so we move on and it says that X, Y, and Z are treated as entities separate from W and classified as a domestic corporation for the purpose of 1.6038A. Now what all this means is that for the limited purpose of filing Form 5472, your single member LLC is now seen as a domestic corporation and needs to file Form 5472 and 1120. Now, that is just the limited purpose. Just because this regulation makes your foreign-owned single member LLC a domestic corporation doesn't mean that it's a domestic corporation for all purposes. You're just required to file the information return, which is pro forma 1120 and the 5472. Filing those pro forma information return does not transform your LLC into a full-blown corporation for all purposes. So it's very important that you understand the differences in this analysis. We move on and it says that each of the transactions in year one is a reportable transaction in respect to X. Now, when we say in respect to X, it means that if X has any reportable transactions, it has to file those information report itself, not the parent. So here you would have X filing pro forma 1120 and 5472. And that is because X received contributions from W. So the contribution from year one here that X received, when X files the 5472, it's going to declare that contribution that it received from the parent. Another reason why X needs to file pro forma 1120 and 5472 in year one is because X and Y teamed up to make contribution to Z. So these contributions they made here, X is going to report that transaction. So here you can see that X has two types of transactions to report: the asset it got from the parent as well as the asset it contributed to Z. Now let's move on with the analysis with respect to Y. The IRS goes ahead and say that each of the transactions in year one is also a reportable transaction with respect to Y. and we're going to explain why Y has a reportable transaction. Y has a reportable transaction because it received contribution from W in year 1. So you can see that when W formed Y in year 1, it contributed a house to it. So Y is going to take that information and report it on pro forma 1120 and 5472. Secondly, Y also has a reportable transaction because it's teamed up with X. They both came together to contribute, each of them contributed assets respectively to Z, which is a single member LLC. So that information also needs to be reported on Y's pro forma 1120 and 5472. Now let's come to Z. Each of the transactions in year 1 is a reportable transaction with respect to Z. And why is that? Because X and Y teamed up to make a contribution to Z. So as you can see, X and Y, each of them contributed their assets that they have to form Z. Z also has reportable transactions. It needs to file pro forma 1120 and 5472. So the IRS makes a final conclusion here saying that therefore X, Y, and Z have a section 1.6038A, which means that they need to file the pro forma 1120 and 5472 reporting. And then they also have a record maintenance requirement. So whatever information that these 3 LLCs report on the pro forma 1120, they need to have documentation to back it up. You don't have to send the documentation. You keep it in your internal records so that when the IRS comes and inquire or ask more questions about the transactions you reported, you can easily provide those evidence. So that's what all this is about. Alright, so now we know the facts, we've gone through the analysis, and then we also know that we're dealing with year 1 transactions. So when is this returns due? Whatever transactions that happened in year 1. So year 1, if you're in a calendar year, it's going to start from January 1 to December 31st of year 1. And then you wait until April 15 year 2 to file the pro forma 1120 and the 5472. So you don't have to wait to the exact April 15 date. You can start filing your tax return anywhere from January, February, March, all the way to April 15 to file your information returns. If you cannot file it on or before April 15, then you need to file an extension. So you use form 7004 to file an extension that gives you 6 months more. So instead of filing the forms on April 15, now you buy yourself more time, which means that if the extension is valid, then you file your actual pro forma 1120 and 5472 on October 15 of year 2. So in this case, you have the transaction actually took place in year 1, but you have to wait till the end of the year, and then you can start the information return either in January, February, March of year 2, all the way to April 15 if you do not want to extend. However, if you want to extend, the extension deadline is April 15. If you wait after April 15 to extend, your extension is invalid and it's not going to work. So I hope this helps you guys out. And if you have any questions, please feel free to use the link below. Book an appointment with me and we talk about you and your LLC. Have a good day. Bye.